15 of 19 series are aligned with stagflation mild this morning. That is near unanimous mathematical agreement that growth momentum is softening, while inflation momentum is edging higher. The current macro regime is stagflation mild, with a confirmation score of 19 out of 19. In this framework, a stagflation mild macro regime means the growth composite is decelerating at roughly -0.59, while the inflation composite is accelerating at about +0.01, a combination that has historically signaled softer activity alongside persistent price pressure. The coherence score and confirmation score together indicate that all 19 series are pointing to this same configuration, and historically, regimes with this level of alignment have persisted about 52% of the time over 3-month windows from similar starting points. Compared to a month ago, when alignment was lower and the stagflationary profile was more tentative, both the growth deceleration and the inflation acceleration have firmed into clearer signals. In past data, environments like this have often felt like a grind: muted index-level equity returns, more dispersion across sectors, firmer commodity complexes, and a tug-of-war in rates between growth concerns and inflation concerns. Starting with yields, the 10-year Treasury is sitting just below the 4.45% trigger level that the engine tracks for conditional behavior in the inflation composite. The 10-year is currently coded as yellow momentum, defined as a positive rate of change that is above zero but not yet stretched versus its 3-month baseline. In 9 of 11 comparable periods, this coincided with further inflation composite firmness within 3 months. That is a description of how rates and inflation tended to move together in those episodes, not a prescription for today. In labor, the PAYM series carries a red momentum label, with its rate of change below zero and deteriorating relative to its own trailing median. The engine flags PAYMs specifically as having unfavorable momentum inside this macro regime. In 7 of 12 comparable periods, this coincided with additional softening in broader labor market aggregates within a 6-month window. Those are simple historical co-movements. When payrolls momentum has looked this weak during mild stagflation, labor data in the sample tended to weaken further, though not in every case. On the credit side, the spread composite the engine tracks is currently modestly wider than its 3-month norm, giving it a yellow momentum label under the definition of slightly positive spread expansion versus baseline. In 6 of 10 comparable periods with mild stagflation and yellow credit spreads, corporate default measures and downgrade counts drifted higher within 6 to 9 months. Again, that is a base rate observation from the sample, not a statement about what must happen. For equity sectors, technology stands out on the downside this morning, with the sector index off around 1% and marked as red momentum, a negative rate of change that is underperforming its own 3-month profile. In 8 of 15 comparable periods when technology carried red momentum inside a stagflationary regime, leadership rotated toward more defensive or real asset-oriented sectors within 3 months. The record shows that sector leadership often changed under these configurations, but not in a uniform way. The conditional map that sits underneath these regime readings tracks explicit if-then statements based on history. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions, the inflation composite showed acceleration in 9 of 11 comparable instances in the historical sample. Within the framework, that kind of move would strengthen the mathematical case for transitions toward an expansion to acceleration type configuration, but it is still just a frequency count. If the fear and greed index drops below 15 and holds there for 5 consecutive sessions, the confirmation score deteriorated in 7 of 9 comparable instances. Historically, such moves have coincided with regime watch conditions where alignment across the 19 series became less stable. The map is live. These conditions are being monitored daily across all 19 series. Atlas is the automated, rules-based engine inside Given Analytics. Atlas does 2 things in parallel. First, Atlas publishes a view of the macro environment, the macro regime, the confirmation score, the coherence score, and the historical base rates we have been discussing across all 19 series. Second, Atlas runs a fixed 4-layer mathematical framework. price structure, rate of change, risk regime, and market participation, across 407 symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as a potential configuration under the framework, time-stamped and logged as a model reading that members can study. The environment view and the symbol-level condition log sit side by side inside Atlas. They are separate outputs. The regime does not select the symbols. The 4 layers do. Atlas monitors 407 symbols independently of any regime label, and members study how those mathematical conditions have behaved across prior environments as historical behavior, not as trade selection. Atlas runs the framework. Members study the outputs and the environment. Any next step remains separate, may change, and is inherently potential and educational in nature. The morning brief is the public surface. The live Atlas dashboard shows the full 19 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.